Why in the world is inflation still here? The inflation readings actually accelerated in April, with the strongest reading since January. Because of that, many are now doubting the Federal Reserve will pause its rate hikes. This is pushing short-term interest rates up even higher. So why in the world is it still here? Especially considering the money supply has been dropping for over a year now. And the rate at which the money supply is dropping is the fastest decline since the Great Depression. Now, I'll be the first to admit, I was dead wrong about this. I've been predicting for well over a year now that inflation would be below 2%, the official number, by Q1 of this year. And clearly, it's June now of 2023, and it looks like it's reaccelerating. What is going on? Clearly, the money supply is not the only thing driving prices, or else prices would already be a lot lower. So I've had to take a step back, relook at things, investigate, do some research, and figure out what are the other pieces that influence prices, and do those pieces have enough influence over prices to have any explanatory power over what's going on right now? And it turns out they do. Real quick, a word from today's sponsor, Monetary Metals. Gold has been a hedge against inflation and failing currencies for thousands of years. But one of the biggest objections to investing in gold is that it just sits there. It has no yield. But what if you could earn a yield on your gold? That's exactly what Monetary Metals is here to do. But how? Monetary Metals connects your ounces to companies that need physical inventory, jewelers, mints, refineries, mines, etc., which means you can earn between 2 and 4% on your gold and silver. And if you're an accredited investor, you are eligible to earn even higher yields, such as 19% on a recent offering. Just to be clear, if you start off the year at 100 ounces and you're earning 3%, at the end of the year, you have 103 ounces. Regardless of what the price of the metal does, you're not giving up any access to the price gains or the price losses. Simply, your ounces are growing. It's genius, it's a win-win, and it's incredibly innovative. Now, as you might imagine, I had many questions about the details of how Monetary Metals does this. So I spent the last year talking with them, grilling them, and I became good friends with the CEO and founder, Keith Weiner. After making sure it was legit, I opened up an account with them myself, and I'll be using their services to grow my ounces. I've also spent quite some time now asking them, please let me advertise for you. And I'm the first one they've ever sponsored. They've never done any paid advertising up until this point, but I finally convinced them and they gave in. To get started, you can either buy metal directly from them and put it to work, or you can ship to them metal that you already own. It's time to get on your own personal gold standard. Earn gold, denominated in gold, priced in gold, and most importantly, paid in gold. For more information, in order to get started with opening up an account, visit the link in the description below. So first, let's take a look at the most basic explanation about what causes inflation, which is just the money supply. For this illustration, the easiest way to understand it is that we have a pizza with 8 slices in it. The 8 slices of the actual pizza represent the amount of wealth, or some people would say GDP. It just all of the stuff. The 8 slices, the fact that it's cut up into 8 pieces, represents the fact that there's $8 or 8 pieces of money that the whole entire economy would cost. Printing money would be the same thing as just cutting each slice into 2 slices. You go from 8 slices to 16 slices, even though it's the same amount of pizza in total. In order to get the same amount of pizza as before, instead of now having 1 slice, you now need to have 2 slices. Essentially, that's what printing money does. You're not changing the amount of wealth in the system, you're just changing how much money is necessary to get that same amount of wealth. But as with all things, economically speaking, whenever we have some sort of explanation about the mechanics of how things work, there is always an unspoken rule that what you're saying is all else being equal. Meaning, if the Federal Reserve just printed $20 trillion and handed out huge checks to everybody, all else being equal, prices would go up and then they would stop going up. But anytime you have a complex system governed by complexity, where you have feedback loops. Unpredictable dynamics. That means when you push on one lever, something else will pop up in an unexpected place. Things that are by definition, by the laws of physics, unpredictable. So clearly, when we're speaking about the economy, all else is never equal. So the slices of pizza example is helpful to understand the mechanics of how just that one part works, but in reality, there are always other things at play. And over the last 6 months or so, there are two major things at play that are pushing prices higher, even though the money supply is dropping. Two forces strong enough to counteract the declining money supply and make inflation higher regardless. The first one of these forces is money velocity. As you can see, over the last couple of quarters, the velocity of money has been increasing. Money velocity is not yet at its pre-COVID level, but it does look like it's increasing and getting there quickly. It's also important to note that the money supply is still much higher than its pre-COVID level. So what does this mean? First, let's look at what velocity is. The velocity of money is very simply the frequency at which dollars are used to purchase goods and services during a given time period. What this means is that money velocity is not necessary to cause inflation, but it is sufficient. This means that you can have inflation without velocity being there. This is why, despite velocity being at multi-decade lows during 2021, inflation during the same time was reaching multi-decade highs. So you don't need velocity in order to have inflation. But if you do get velocity, that can be enough to cause inflation. And right now we are seeing velocity increase with a monetary base that is a lot larger than it's ever been. This is how US consumer spending is increasing, with rebounds in orders, a pickup in business activity, and increasing incomes. For a very simple explanation of what is going on when velocity increases, imagine there are 3 of us in one little local economy, and I have $1. It's the only dollar. Throughout the course of the year, I spend that dollar one time. I spend it and I give it to you to buy a coconut. So velocity is obviously very low and inflation is not really gonna happen because that coconut only got bought one time. But if you buy something from me and then I buy another thing from you with that same dollar and we just keep on trading that dollar back and forth with each other, during that same year, both of our incomes will actually increase. You don't need more dollars in the system for that to happen. It's the same dollar going back and forth. So velocity increases because it happens in a shorter time period. So because my income is higher, because that dollar keeps on coming back to me, I'm able to afford to buy more and more things from you. And that's exactly what's going on economically speaking right now. You do have incomes rising. You do have people spending more money, even though prices are higher. And as that money gets spent, that goes into the business checking accounts of those businesses selling those things. And then they're able to use that money to pay their employees a little bit more to keep their employees, and round and round and round it goes. So to the extent that we see an increase in velocity, and that velocity is happening to a money supply that is much larger than it was prior to 2020, we have the capacity to see inflation really get entrenched here. But that's not the only thing that is causing inflation right now. We have a second factor that is arguably even more of a contributing factor to inflation, and that is deficits. Now, for the most part, when people hear that government deficits are inflationary, their mind thinks, well, obviously, because they're printing money. But no, they're not printing money. In fact, since April of 2022, the Federal Reserve has not on net been printing money. They have actively been sucking money out of circulation, which has caused the total amount of money to decrease. So the government is spending more than it takes in taxes, but it's not doing that by using newly created dollars, newly printed money. It's borrowing that money out of the productive economy. So even though the government is spending $1 trillion, $2 trillion more than it is taking in from taxes every single year, this is not increasing the total amount of money out there in circulation. The total amount of money is measured by M2, and that is in fact decreasing. So if deficits aren't being funded by the money printer, then it's not an increased amount of money causing the inflation here. So can deficits even cause inflation then? Absolutely they can. The government is very simply a wealth transfer mechanism. So you go to work, you're productive, you increase the wealth of the company that you work for or your own company, you make them money, and in doing so, they share part of that with you and you make money yourself. So you are productive and you are adding to the total stock of wealth in society. So you are a wealth producer. The government then takes a look at you and says, you are producing wealth, we want our cut of that. So they take some of that. So they take resources away from the wealth producers in society because those are the only people who have wealth are the wealth producers. They take some of that. Now, the only place that the government will spend that money, aka transfer that wealth to, is to places where they are not producing wealth. I'm not getting into whether this is good or bad or right or wrong. I'm just simply stating facts of the way that this works. So one example of this is Social Security. These are people who maybe used to produce wealth and very likely did produce maybe even a significant amount of wealth in their lifetime. But those transfer payments are coming from the currently productive people in society and transferring them to those who are no longer or are not producing any wealth. Similar would be like government contractors who are producing weapons and bombs, dropping them on children in the Middle East, or to fulfill the paychecks to politicians. So this means every area that the government sends money that it takes from productive individuals will either go to an area that is not productive or less productive. And currently, the federal government takes almost 20% of GDP in taxes, meaning every single year of all of the wealth production, the government's gonna take 1/5 of that and send it somewhere else where it is either less productive or not productive at all. As you might imagine, this has a wealth destruction effect, meaning it results in less wealth overall than there would be without these massive transfers. Now, you may argue that this is a good thing. You may argue that this is morally correct. You may argue that it should happen even more. But it is a fact that that's what government taxes and spending is. It's taking from the wealth production and distributing it over to less or zero wealth production. This is a misallocation of resources from the standpoint of maximizing wealth. So why does this matter? Go back to the pizza example that we started with. All else is not equal. That pizza is trying to grow, meaning all the little people that make up that pizza, they're doing work to add ingredients, add more flour, add more water, add more butter, add more flavoring to make that pizza get larger and larger and larger, make that pie grow. And every year, the government is taking 20% of that pizza and lighting it on fire. So what does this do to prices? Well, number one, if you take a look at the areas where that money is diverted, it obviously drives those prices up. One fantastic example of this is the cost of healthcare. Since 1970, the government has poured more and more and more money into spending on US healthcare per person. All that has done is drive up the cost as healthcare providers have hired more and more and more administrators, meaning the quality either stays the same or in many cases is actually reduced, but the cost is exponentially higher. And obviously this is going to happen. If you're an industry or you're a company, you're a sector that's getting a bunch of government money coming at you, you're gonna have to compete less and less. You're gonna be able to raise your prices because the people can afford it because your products are now subsidized by the taxpayer. Same thing happened in education. That's why universities are so much more expensive today. Administrator growth has skyrocketed and the quality of education is either the same or worse, and the return on that investment is a lot worse because everybody has degrees now subsidized by the taxpayer and they don't actually pay for skills that are gonna make you more money in the long run. So that's the first effect, is that everywhere the government spends its money, those massive transfers, those prices themselves are going to skyrocket. So that absolutely contributes to higher inflation numbers. The second effect this does is it leaves less resources available for the most productive areas of the economy, which means that when you're measuring all the money versus all the wealth, like we did in the beginning with the pizza example, the wealth side of the equation is actually being impacted. Because of these massive transfers away from the most productive to the least productive, there's less wealth. And this has always been the case. This is nothing new. But GDP growth and the growth of real wealth has always been able to outpace that. And that is very quickly now changing. The burden the government is imposing on the economy is becoming greater and greater. And especially with the growing concern of higher and higher interest rates, it seems like that's a train that is not slowing down anytime soon, that burden will only get bigger. If only there was a word for when there's less wealth at the same time as prices are going up. Something like, I don't know, stagnation inflation. I don't know. Somebody should come up with a word for it. As always, really appreciate you guys. Thanks so much for watching. Have a great day.